Going through the Q1 2023 earnings season that we are just about ready to wrap up. So we're going to be talking about companies, so just a handful of companies that we found interesting, just to share perspectives on what we might have seen in the report. So I'm joined here today by a good friend of mine, Greig Lindo, who is Assistant General Manager for Treasury and Trading at JMMB. JMMB Moneyline is also a sponsor of this video, so we thank them for that. I'll talk more about their platform later. So, let's just get right into it.
Learning is the key to successful investing. And who doesn't want to invest in some way?
Here at L.E.A.R.N Grow Invest, we focus on financial education, all with the aim of sharing our knowledge on personal finance, investing, and building wealth. We do this on the foundation of our faith in God.
If a more holistic approach is what you need, check out our Grow Faith-based financial coaching program.
Find out more about us at learngrowinvestclub.com
and follow us on all social media platforms at Learn Grow Invest.
I pray that you will continue to bless this community in Jesus' name. And all right, so join me in welcoming Greig. Greig, how are you doing?
Hey, Jeremy, I am good. Good to see you. Good to see you.
Same here.
Mm-hmm.
All right, so we've done this.
The sound is going in and out a bit, Jeremy. So I lost it.
Going in and out. Is that better?
Yeah, a little bit of feedback.
All right, let me
sure.
check something here. Everything is normal on my side. It could be just bandwidth going in and out.
Okay.
But I'm here. You are here. If anything.
Yeah, I can hear you now. I can hear you now.
Okay. All right. So I was just explaining to persons who are here. Companies that would have come out for this, earnings season that we are just about to finish out here. We're just kind of be going through companies in no particular order of interest or anything like that, but just some companies that we think are interesting to discuss. And as questions come up or as persons, mention companies that they may want to see, we may talk about those as well. So, feel free to start us off. Are you hearing me?
Yeah, I hear you. There's sometimes when there's disturbance, but I hear you. I heard you the last.
All right, so let me see if that's better. Is that better overall?
Yeah, we can continue. I'm able to hear what you're saying now.
Okay. All right, so I wanted us to just jump right in. I think we're going to be starting with NCB.
Yeah, sure. All right, so NCB, a company that needs no introduction, right? the largest financial institution in Jamaica by balance sheet, certainly one of the largest institutions in the region. We would have seen the stock really been in a bit of a downtrend over the last couple of years. The stock would have peaked out in excess of $200. Then it came down, and the performance has generally been to the downside. But I guess where we can start is with the most recent report, which would have been their Q1 report for the period ending December 31st, 2022. So we have to kind of, to set the context, we have to look at a few things. One, NCB's overall business strategy, which has been really along the trend of digitization. We've seen what they've been doing with Link. We've seen them really making a move to the non-traditional channels of banking really to in a bid to increase efficiency and enhance the offerings that they have to their clients. In years gone by, the NCB would have been on an aggressive acquisition trend, right? They would have acquired a number of institutions, Guardian Holdings included. They would have acquired 62% of Guardian. They would have acquired Clarion Bank in Bermuda. They also would have restarted they would have expanded their footprint in Trinidad through NCB Merchant Bank. You would have seen the hub and spoke wheel concept where they have a presence in Cayman and Barbados. So the growth has always been on the agenda of NCB, and I still believe it is. So fast forward, we're in a very challenging environment that is for financial services globally. And certainly the last report, you would have seen a precipitous fall in their profitability. So we have to look a little bit deeper in terms of what's happening or why, what explained this drop off in profits. So the first place, we'd start is the income statement, where you'd see that their net interest income, if you look versus the previous quarter, it would have been down. However, if you compare it to the same period last year, it would have been higher. But what you have to look at this against is the increase in their balance sheet. And what the story is pretty much saying is, look, there has been a lot of increases. Well, there has been increases by the central bank, that's the BOJ, in terms of the benchmark rates that they would have paid on deposit taking institutions for overnight funds, right? They would have moved that rate to 7% and then paused. So what this has represented is an increase in the cost of funding for institutions like NCB. No, this is not just their only source of funding, as of course retail deposits and other account types would have been a big part of their funding structure. But the funding costs that would have, or the increase or additional costs they'd have to pay to access wholesale funding, this is like funding from like other large institutions that fund banks, would have gone up significantly. So likely what would have happened, you would see happening is that the spreads that NCB are able to earn would have been compromised, or I should say contracted is a better word, because the loans that NCB makes are typically long term, right? And the ability for them to reprice their loans, we would have noticed a number of banks would have gone through at least one round of rate increases on their loan portfolios, whereas the cost of funding those loan portfolios would have gone up almost instantly. As BOJ makes a move, it translates into increased cost of funding, particularly on the wholesale funding side. So that's been a challenge, and it's not unique to NCB, but certainly when you see the banks increasing their rates on loans, it's because of this. So net interest income is normally it is the largest line if you look at it from the revenue standpoint. NII is easily the largest earner on the operating income side. Then you have things like fees and commissions. Then you have like insurance revenue. So to see a challenge on that side is gonna, when you know there's a challenge on NII, it's gonna filter out into the overall performance of the company. Fees and commissions, I would say fairly flat quarter versus quarter, but of course that's a very strong line for most financial institutions. And of course, this is not just fees charged on transactions. There are also commissions that they would have probably earned from doing deals. originating loans, those sort of fees would have come up in this line. And of course, we also have credit impairment losses, right? Which is I don't want to say it's a negative factor for earnings, because of course, of all the loans that you make under IFRS, you have to provide for loans that may be going through credit stress. So the NPL, or your non-performing loans ratio, is a key metric of that. But if you look at it quarter versus quarter, it's relatively flat, but it's still a decent expense in terms of 1.8 billion over the three months. So when we look at the challenges on the revenue side, I mean, they were able to grow revenues certainly for their 2022 quarter versus 2021. But when you look at some of the expenses, I mean, it's been a bit, it would have challenged their operating profit, right? Because you would have seen their net operating income would have fallen. And this has to do a lot with a slowdown in the insurance line, which, of course, everybody knows 62% of Guardian was acquired by NCB. And, that has really been a key driver of their earnings. I mean, Guardian has done very, very well. But, every business goes through cycles. Insurance is no different. And we would have seen a bit of a contraction in that business over the last quarter. So if you go to the I think the page 10, this is a good example of how each business within NCB performs, and it also gives you a good line of sight in terms of what are the key business drivers for NCB. So you have consumer and SME banking, payment services, which I guess Link would fall under, corporate commercial banking, treasury, correspondent banking, wealth management and investment banking, which is largely NCB, capital markets, life and health insurance and pension fund management. That would be between Guardian and NCB Insurance, and general insurance, which would largely be Guardian General, right? And then you have the other and consolidation adjustments, which are really, I guess, expenses or things carried across for the group. So if you look at it, what stands out is the largest contributor to operating profit for this period really would have been general insurance, right? And it would be followed by treasury and then corporate commercial banking. So those, as of the last quarter, would have been the top earners for NCB Financial Group. If you look at how this compares to last year, if you go to page 11, you'll see that the lines there would have seen quite a bit of change. So you would have seen year over year where the operating profits of general insurance would have moved from a little under $1 billion to 2.4 billion, which is a marked improvement. Whereas on the life and health insurance line, you would have seen a massive contraction where it fell from 8.3 billion to a little over 1 billion. The wealth and asset management line, you would have seen that also contract from 2.25 billion to operating profit of 678 million. Treasury and correspondent banking would have seen a bit of a fall from 1.9 to 1.7. Corporate commercial banking from 1.6 to 1.3. Payment services from 487 million operating profit to 241 million. Although if you notice, the revenues would have moved from 5.7 to 7.1. So that is probably indicative of a nice performance for the future of business subsidiary, which is really focused on this type of transactions. And of course, consumer banking, which is your everyday banking, which is actually not contributing to profitability. It's moving from a loss of 321 million to 600 million. So this part of the statement kind of gives you an idea as to where you can look to see really what has been the main drivers of NCB. And immediately what stands out to you is you have your core banking in terms of treasury and corporate commercial banking that have really been weathering some of the storm. But when you look at things like investment banking, it has been pretty challenging, which is not surprising, right? If you think of outside of Jamaica, what's happening globally. Deal making has slowed down, trading has slowed down. I mean, a number of international banks have actually reduced the size of their trading workforce, just because there's less deals to be done with a higher interest rate environment, with a tighter monetary policy. There really is just not the room or capacity to do maybe the amount of deals that you did in the previous year, and that has implications. So certainly it's not maybe something that we would say is indicative of the entire future, but certainly for the time being it's going to be a rough time, because we expect conditions in global markets with regards to interest rates to remain elevated at least for the majority of 2023, with maybe some softening towards the end of the year, going into 2024. And then, you have to think about it in the context of if there is a recession, right? If there is a recession that happens in the US, and if that filters to Jamaica for whatever reason, it's gonna affect banks, right? Because persons have loans, persons have businesses, and we're not immune to what happens globally, right? We are an interconnected financial system, and when things happen overseas, our central bank also has to respond. And I think what you're seeing is an immediate impact of some of that response on the numbers. Now, there are other things, if you're to drill down into things like the IFRS 17 changes that are coming for NCB, Insurance and Guardian Holdings, in terms of how that's going to impact how they actually book their insurance premium revenues. Now, I'm not an IFRS 17 expert, but it is certainly something that you should pay attention to. I know Guardian has been sensitizing the market in terms of the potential impact on them. They had an investor seminar, I missed it, but we see where also Sagicor Financial would have reported and put out a statement on it today. So it's certainly something that insurance companies has on its radar. And again, you need to pay attention to this for the likes of NCB, because as you see, it was a significant fall off in their operating profits, as well as their revenues from insurance would have taken somewhat of a dip as well. So it's going to, I do think that moving from such a big net result on insurance from 5.7 billion in 2021, the same quarter, to an actual loss, there's obviously some, I'd say, non-recurrent adjustment that was likely made. So they'll have to look and say, okay, well, what does that mean for the company moving forward? But at the end of the day, they still remain, in my eyes, an institution that has deep reach, and they're gonna have to weather the storm like everybody else, So it typically provides a gauge, because it is one of the largest companies by market cap on the JSE. I think Sagicor overtook them. So whatever happens in terms of that stock price is going to certainly have a bit of a weight on the wider market. So with that being said, if we look at the technical trend, that graph there that you have kind of says it all, right? We see where it's kind of had a bit of a bounce, but now it's been trending downward. So if you look at it, say from, I think in April last year, the 100-day moving average crossed above the 50. Don't think Moneyline has that yet, but we're working on that. But so I mean, usually what you have is when the long-term moving averages cross above the short-term ones, that's a bearish trend. Now we're at an interesting time in the market, and maybe this is a good time to say, well, we're a few days away from the close of the quarter, right? So the stock price has obviously been under a lot of pressure, and I do think that there's a lot of headwinds that remains in the market. It's probably that may very well challenge the stock price in terms of upward mobility in any sustained way. By that I mean, towards the end of quarters, end of financial years, there typically tends to be somewhat of a bit of a support that comes in for certain stocks that are held in certain portfolios. So it wouldn't be surprising if this is some buying coming in. However, given the headwinds that are being faced by markets, as I said, not unique to NCB, it's gonna be a difficult time for the stock price. So even though
So
when you look
a
at it
couple of
from
questions, right?
yeah,
One second. So Craig is asking if you think, well, why do you think that NCB has yet to
that
pay a
what
dividend?
the last year, Jeremy.
Craig is asking, why do you think NCB has not yet paid a dividend?
Well, a very very good question. So the thing with dividends and NCB has been they've stated that they have not been paying any dividends because they are really looking at their optimizing their capital structure, right? So what that means, there are some regulations that are coming in to financial institutions. It's called Basel 3. So that's gonna mean that their institutions are gonna have to hold a greater level of capital against their investments and loans, due to changes in the risk weightings. The long and short of it is when you pay a dividend, you are paying your dividends most likely are paying it out of retained earnings. So it has the effect of reducing shareholders' equity. So it's effectively reducing your capital. So to the extent that they are trying, their balance sheet is growing, or they're making more loans, or they want to be able to put themselves in a position to make loans, then they need to have capital, right? So it's either you're going to do things like maybe say, all right, and we're going to hold off on dividends because we feel like it is more it's beneficial to shareholders and other stakeholders to make the loans or expand the business, as opposed to paying out maybe a dividend, and you may not be able to because you cannot breach your capital ratios. That now becomes a problem. So until the situation, especially in a time like now, with some of the things that we mentioned with interest rates and the volatility in global markets, asset prices could face headwinds. All of those things mean that you'd want to keep as much capital available as possible, which is likely one of the reasons why they probably said, well, okay, we're going to hold off on dividend payments now. And it's either that or you go to the market and raise capital. So is the market in the best condition for you to raise capital now? Not necessarily. We're talking like tier one capital. So they need, you're talking like ordinary share raises, or maybe some like perpetual preference shares, things like that. Are those things, are you able to do, the question they be asking is, are we able to do that successfully in this type of market? And so for now, maybe the answer is, we'll hold off on dividends and then reassess at that time. The Certainly there are options, but again, it comes down to how the executives, what they want, what they choose to do in terms of how they see the business going forward. We know that NCB is about efficiency, about the use of technology and digitization. So right now they're making significant investments in that. So down the road, when those things take root and they start to really deliver, then I'm sure you'll probably likely see, some amount of dividends being be repaid, and they may, depending on how well they do, maybe they might give you barter. I don't know, but certainly in a challenging time like this, they would likely want to conserve capital to ensure that they are able to, fund whatever they need to fund, and be above the thresholds for the regulatory requirements.
All right, cool.
Yeah.
So Craig again is asking, what is Basel III?
Okay, so Basel 3, it's all right. So there is it's a capital, it's an international capital standards that is used by central banks across the world. It's really an international regulatory framework, right? So it's really comes out of the Basel Committee on Banking Supervision. So it's a set of rules that have been widely adopted across the world in different jurisdictions, in I guess in the applicable ways, but it speaks to having more, I guess I could say, more detailed capital requirements for how banks do business in terms of making loans. And a lot of this came out of the 2008 crisis, when, of course, a lot of banks would have come under pressure, and there was a review of, in terms of what went wrong, or were regulators doing what they're supposed to do. And Basel 3, you would have had Basel 1, Basel 2, and now we're at Basel 3. So that's what is due to be implemented. And it's across the market. It's not unique to NCB. It's every bank has to adopt these standards.
All right. He's also asking, how has the lack of dividend negatively affected the stock?
It's hard to quantify, but certainly I'd say it has done more harm than good, because prior to the NTB not paying a dividend, there were a lot of investors that use NTB dividends as a source of income, passive income. So with that not happening anymore, then I mean it would mean that it now becomes less attractive to certain class of investor. Certain investors that maybe depend on things like dividends, they probably say, well, maybe I'll look at something else that's paying, like Career Rust or Trans Jamaica or something like that. So it's hard for me to quantify to what percent it would have fallen because of dividends, because of course, other things would have been happening that would have impacted the stock price. But certainly not paying a dividend makes any stock less attractive to certain investors. A lot of people like to look at NCB like a growth stock, but because they're kind of reorganizing themselves, they're reprioritizing what they do. So NCB, certainly they're doing things differently, but they are a mature stock that's widely held by different sets of investors. So not paying a dividend is going to be more of a problem to some investors than others. I know investors that usually buy a lot of these stocks for dividends. They're investing large amount of capital, but not paying a dividend means it's less of an option, which means a potential buyer that could come in to take 100 to 150 million worth of shares, they might look elsewhere. So you can't discount that either. So anything else on NCB? Oh, well, before I wrap up on it, I mean, so yes, so we would have seen I'd say a report that's underwhelming in terms of performance, but NCB is trading at the book value, it's almost trading at about book. And I mean the PE, which I don't really tell people, hey, don't look at PE in isolation. The PE is low. It's about below 7, I believe. But there are a lot of headwinds. So in some circles the PE is justified, whereas in other circles it's cheap. But certainly there's a lot of headwinds for the financial sector. So that's something that we can't ignore. And I mean the market is basically saying saying that same thing. They're saying, at $71, it's way off of its high. The 52-week high, I believe, was NCB. 52-week high was $119. So that's a nice little ways off. But long term, I don't see a lot of prospects given market conditions now. But if you believe that NCB will remain a dominant player, which there's no reason to say that it won't right now, then it's a compelling investment to look at.
All right, cool. I think we've gotten most of those questions. Apologies to those persons complaining about audio issues on my side. I'm going to try to switch microphones. I can't be able to see it. I didn't want to not be able to answer Greg's question. Craig was also asking about overnight funds. You had mentioned that earlier. He wanted an explanation on that.
Yeah, sure. So overnight funding are the placements mainly by other institutions with the bank. Clients can ask for overnight funding. It simply means you're just rolling your money on deposit overnight. But certainly in what you call the interbank markets, which are the markets where banks exchange funding against clearings, there's a lot of overnight lending. And those rates are largely influenced by what BOJ is paying, because a bank or deposit taking institution can put money on overnight at the central bank. So if the central bank is paying you 7%, then that simply means that if a private party wants to borrow, they probably need to pay in excess of that, because the central bank facility is accessible by any DTI. So when we say overnight funding, it's just the amount of funds that an institution may need to borrow overnight to meet their clearings. Now, doesn't mean they have to borrow overnight, but it is a normal function of the market.
All right, thank you for that, Craig. Craig, which other company are we looking at?
Probably we could switch gears and look at Fesco. I know you had the earnings call the other day.
All right, so I wanted to switch my microphone. So you want to share from your side as you go through, so that I might have to disconnect and come back. So I share
well, let me see what I could do in terms of in the reports.
It won't take me long, but if I disconnect whatever I'm sharing.
Well, let me try then, no?
Yeah.
Okay, share screen is easiest with monitors. All right.
Yep,
Yeah.
we're good. So just zoom in a little bit. A little bit more. And then we're good. Okay. So I'll be right back.
All right. All right. So until Jermaine returns, I guess we'll just have a quick discussion about Fesco. So, of course, Fesco, one of the not so new kids on the junior market, having a really stellar quarter to end December 2022. Company has really exhibited very strong growth since listing on the market, which is always good to see, because I like when new companies come and they grow, right? Because that's the whole purpose of listing on the junior market, is to grow your business. So looking at the 9 months performance, we would have seen very strong growth across all top lines. We would have seen turnover, or the revenue or sales, up by over 150%. You would have seen gross profits up 162%, which as soon as you say that, you know that there has been some margin expansion, which is always good, especially for the gas station business, because it's not a business that has typically very wide margins, right? The margins on gas are relatively thin, which means that really it's about selling more gas rather than how you price it. Because we know that Fesco is in the market as a low cost provider of gas, which means that they are really trying to run the business on fairly tight margins. So you would have seen revenue really grow from 8 billion to over 20 billion, which is very impressive. Would have seen a margin expansion, as I would have mentioned. There was a contraction in finance income, although I do expect that to change moving forward with the issuance of new debt. Fesco would have taken on debt to expand its LP, or start by acquire assets to grow into the LPG business, which is also an area which they see it has great potential to provide returns for shareholders. The current ratio, which is really a measure of their current liability, their current assets over their current liabilities, is 1.6, which has grown relative to the same period last year, which means that they have more cash, more access to working capital. A part of that would have been, proceeds from the bonds that they would have issued now on their balance sheet. The debt that they have would have also significantly grown, which debt is not necessarily a bad thing, right? They were able to raise the first tranche of the debt at, I believe, 7%, which was really, really good timing when you think about it. When you say other issuers in the market now that are established players raising money at 11%, 12%, some 13%, raising that debt at 7% was pretty beneficial for them. And it shows in terms of the management, or how the management or the executives are looking at the management of the business, right? The debt equity ratio is 1.66, which is, in my mind, still relatively low, in terms of a leverage ratio. You need capital to expand a business like this, right? Because it has strong cash flows, but you're definitely going to need to buy expensive infrastructure to expand the business. You're talking about building gas stations, right? Or franchising, which is something that they're also doing. But it's not. It takes a lot of capital. So in terms of getting affordable, or I should say relatively cheap debt funding to do that, is an advantage, because certainly when you look at the return on equity, then these transactions that they're doing in terms of expanding gas stations and all of that will be significant for the business moving forward. So I mean, there's a very good performance for Fesco in terms of fundamentals. I do expect to see a little bit more. Well, we're gonna see some growth in finance income, but certainly at the rate at which they're able to grow sales is significant. And moving forward, December 2021, we would have, for the most of that year, we would have still had the effect of the lockdown. So when you compare next year, it's going to be a little bit more normalized, because you don't have what you call the basis effect, meaning the denominator which you're comparing to was skewed negatively by a non-recurrent thing, because we don't expect to be going back to things like lockdowns and all of that. So Fesco should be allowed to freely grow over the next year and years to come. So I don't know, Jermaine, if you have any questions. I mean, the only thing I would probably add now is look at maybe the share price movement.
Okay. Yeah, let me bring that up. My side. So Devon was saying it's a little too small, but I think maybe
Or
okay. No,
the screen, or
yeah, man. I think it was a text on the screen. So what I'll do next time you're
well,
sharing is
yeah, and I think what we're looking at too is you can pull this document from the JSC because it's their
yeah,
last quarterly report. So if you want to look at it, and I would suggest that everybody read it if you're interested in FESCO. Download it at the stock exchange website, and you can have access to it. So it's not something that was proprietary to me, but it's the same document that's on the JSC website.
yeah, and definitely also take the time to check out the earnings call. And a lot of context was given in that call as well. So just
Yes.
something that you can refer to there. Yeah. So sharing the
Mhm.
price.
Okay, yeah. So really, it has Fesco has been in somewhat of a downtrend, I would say, since around maybe July 2022. The peak would have been in March, where we would have seen the stock hit a high of I think $8.49. So for persons that bought up there, I feel your pain. But that's how it goes sometimes. The stock has been in a bearish trend, and this is evidenced by the moving averages. Would have seen the 100 and 200-day moving averages cross below the 50-day move. Well, the 50-day moving average would have crossed below the 100 and 200-day moving averages, which is really pointing to lower prices. The stock has shown a bit of resistance, well, support, I'd say around $4. Right now, I think it's around 428 is where it's ended trading today. And interestingly, a key thing to note is back in I think it was July 2022, July 5th is when we saw a massive trade of 241 million units in Fesco, which we now know was purchased by a financial institution. But the trading for that day was between, I'd say, $6 and $6.50. So I mean, we don't know if that's their true entry point, because there are things like rebates and all of that stuff that would help change the entry point. But we do know that a large block was traded in the $6, above the $6 range, which in my mind, it can mean different things, right? Because certainly if any support was to come for the stock price, that is certainly a mark that you'd want to note. But there has been significant trading in Fesco. I mean, it does tend to move with a decent level of volume, right? Although it's a bit on the slow side now, but so is the entire market. I mean, trade values are down based on my last check. So it's in a bearish mode, but of course, looking at it from a performance perspective, the stock has been doing well. Looking at it from a earnings to price perspective, the PE has come down significantly. I believe the PE is somewhere around 19 times now, or almost 20 times. The price to book is still a little bit high, but certainly it's something. It's a stock I would watch for the future. I mean, it's down 22%, 22% year to date, which by any means it's been beat up a bit. But for those that like a compelling story and believe that the market will gravitate towards these performances, then fine, it may check a box. But as I said, there are many headwinds that are gonna affect the market moving forward. So I have to be mindful of that. But from a business perspective, Fesco has been doing well, and I expect them to continue to do well, because you haven't seen the investment from the LPG lines coming yet. You haven't seen their growth strategy through dealer-owned gas stations and company-owned gas stations is still ongoing. So you'll see new gas stations, which means more revenue, more gas. So focus on the volume of gas not the price of gas, because as the results show, Fesco is only making maybe at their last report, their margin was 3.2%. So whatever they get from Petrojam, that is the general markup they have on their price. So when the price moves, they still have to pay Petrojam. So they're paying Petrojam a higher price. So seeing the prices move up aggressively. I mean, we're not seeing that now. We're seeing prices kind of get soft. It also works for them, which means they're still taking their spread, and the gas is more affordable. More people buy gas, so the lower gas prices probably benefit them more than the higher ones. Mm-hmm. Any
Yeah,
questions?
interesting, and I do agree as well. I think their strategy for growth puts them still in a good position. Um, so I mean, I see Craig asking here, having rolled out all these gas stations, what's been the rate of return? What's been the return on interest? I mean, can we
Yeah,
quantify
but
that?
you can. No, all right. So because we don't have the granular information to say what each gas station is contributing, but you do
Yeah,
have the overall return on the business. So they made 434 million over the last quarter. So you can do a quick calculation of what their return on equity is. Let me just see if I can find that here. Okay. All right. So let's say. All right, so the year to date 434, and you divide that by their where is the balance sheet? Mm, my mouse is moving slowly, but all right, here we go. So the total equity is that. So that's about a 37% return for the
one sec, Greg.
9 months, over nine
Zoom in a
months.
bit.
Hmm? Sorry, I didn't get that, Jermaine.
Can you zoom in a bit?
Oh, okay. No, I'm just saying. So you're
Perfect.
looking
I
at
think that's
the
good. That's good.
434 million in profit, and you want to look at what that return is versus the capital they have as at the end of the period. So that's roughly a 37% profit absolute. I mean, you can if you annualize, it's probably more. So I mean, what that's telling is that boy, for the profits that the company is generating, I mean, that's a decent ROE in my mind. Forgive me. I'm used to abusing a Bloomberg, so I have to manually calculate these things, and see, I'm look at my calculator here, which I'm surprised it works. But so yeah, but the long and short of it, the ROE is actually enhanced by the fact that they use debt, because what that means is that they'll pay for it in terms of increased finance income, which is the interest that they're paying on the debt, but they're not diluting shareholders by issuing more shares. So if you do that, then you're increasing equity. So if you're increasing equity, you want to ensure that the return that you're getting also goes up by a larger percentage. So you definitely, this is when you talk about good debt, bad debt. When you can use debt to increase that return or that profitability that you have without diluting shareholders, and it's affordable because it's not killing your bottom line because it's reasonably priced debt, then you see immediately how it can add value to any business.
Yeah. Thanks for
Yeah.
that, Greg. Greg is saying 37% is definitely not bad. Um, yeah. So
Well, for
yeah, I mean, I
return on
just say
your
that for them, I do see them growing quite a bit over the next couple of years. I think that they have a solid brand. I think let's see how the market responds to Fest Gas when it comes out and what that does for the bottom line. That was promised to be for Q3 this year.
Mm-hmm.
Um, So we'll just see. I think based on the type of correction it's seen, there is some opportunity. But of course, those factors that you mentioned that's affecting every single company is going to also affect them in terms of just
Yeah,
general
yeah.
market
And
conditions.
mhm,
So
mhm. You also have to pay attention to EV because I mean EV. I think we're still some years off in terms of adoption in a
yeah,
mainstream kind of way. But of course, the EVs are opposite of what they're doing. So to the extent that you start to see more and more EVs, maybe it doesn't really impact their target clientele because maybe who they're targeting is really not EV minded. But as the country moves towards it, then that's something that they would definitely have to monitor.
yeah, it's something that Jeremy said that he will base his decision based on one, banks and other lending institutions providing a reasonable model for persons to be able to acquire EVs. When we did an interview with him last year, that's what he said, where he hasn't seen any bank or lending institution provide something that is reasonable for the average consumer to own an EV. So to them, it would be too early to seriously look at the market.
Yeah. Yeah, agreed. I mean, the government has relaxed duties, but when you really check the price of EVs, because I mean, most people would want to probably buy it new. They're still pretty expensive. So,
Yeah.
so for the persons that maybe want to get into an EV, it might still be a little bit out of reach. But certainly, when you start to see the more affordable options come to the market, then it will be interesting to see how that is. Because I mean, Hyundai has EVs, Kia has EVs. So the fact that you're paying lower duties on these cars, it may make it super affordable to get into a new EV at some point. But for now, I think even these dealers are kind of assessing what's the real demand for them before they start to bring in these units.
Yeah, agreed. All right. So, Greg, I think we have a final company that you wanted to look at before we take questions.
Wisinco, a popular company, to some a boring company, but to some it's a solid company, right? Wisinco probably one of the best balance sheets in the market. Certainly from a analyst perspective. If you want cash flows, if you want low debt, if you want decent margins, decent profitability, then Wisinco has all of that, right? And their last quarter was no different. I mean, their 6 months ending December, they would have posted profits of 2.5 billion, revenues of 24 billion. So we think of continuing on stride in really a high inflation environment, right? Which is key because if you think about it, right, we think because the most of the products that they would distribute or manufacture are more consumer discretion, are more to the consumer discretionary side, right? So you think about things like Coca. Well, to some people, Coca-Cola is that is they need that, right? And they have to have that. But some of the other products in their portfolio are really um, not they're not necessities. So think in a high inflation environment where obviously prices are going up, right? They have still been able to maintain and in many ways grow their wallet share, which is evidenced by the increased revenues that they're taking in. So gross margins are pretty attractive to me. I think about it's all like 35%, 8.5 billion over 24 billion. So that's a decent that is decent. Net margins looking at about 10%. So you see you compare it immediately to Fesco. You see Fesco is working with a 3.2% gross margin and their net margin was significantly less than that compared to our Cinco that's doing 2.5 billion or 10%. Granted, very different businesses, right? One distributing gas, the other is distributing consumer products. So very, very healthy performance by Wisinco. The business is healthy. Looking at their cash flows, which I didn't really talk much about, and we probably need more time if we're going to talk about a lot of these performances. The operating activity cash flow is significantly higher. We were significantly lower than the previous 6 months last year, but still at 1.2 billion, right? So if you look at that versus what they've been doing on the investing side, they've also used about 1.5 billion in cash. So rarely, but you've seen it where they have used about the net cash usage for the period is about 866 million. But because they have a significant amount of cash on their balance sheet, over 7.5 billion, that's really not very much of a talking point in terms of how much cash they had to use in the last year. And if you look at maybe some of the main things that happened during the year, there was a massive pay down on payables, right? So they would have paid off some payables, maybe, settle some outstanding bills, whatever. So that's not a bad thing. And they would have also increased their investments in securities, which means the company is actually putting money to work in the investment market, which is also a positive thing. So all in all, that's good. They would have taken on a little bit of debt over the period with loans increasing by $541 million. But when you look at their total loans, it's still a relatively small amount compared to their assets. So that's borrowings of 928 million long term, as opposed to equity of 20.2 billion. That is really small. So definitely a balance sheet that can be leveraged if needed to take on expansion opportunities should they arise. But I know persons tend to say they want to see the more use of the cash. But if you look at it, Wisinco has made some moves in the acquisition space. They did buy a majority stake in True Juice. They have expanded their portfolio. I believe they shed some of their Unilever products. Either they shed it or they bought it. I don't recall at this point, but they have rationalized their offerings to the market. And of course, this is normal for distributors where they kind of cut the products that don't give them the margin that they desire in favor of other products that give them the margins that will give them the return that they need. So it shows prudent management. In terms of the stock price, it's not a stock that's gonna get you too excited in terms of prices. It does have its periods of volatility where if you're able to time it, you may be able to make a nice little return. But for the most part, the stock has been kind of range bound anywhere between $16 going up to maybe at sometimes $20 or so. 17 high going up to 20. It's also like most stocks right now, it's kind of in a bearish trend. The price has been gapping lower. I'm seeing some support for it in the $16 region, but certainly there is potential for this company to make an announcement of some strategic acquisition or some business practice or some new business at any point in time. As to whether the market will respond to it, can't really say, because Wisinco is a widely held company. It had one of the most successful IPOs on the market, so the shares are widely distributed. And when you tend to see that, it tends to have an implication on pace of movement of the share price. So certainly that's something that I would like. I have no issues in terms of the business. The stock, no, you have to probably tread a little bit cautious depending on what your strategy is. Certainly it's from a value creation perspective, the business is doing pretty well. But of course, there's more things that go into that in terms of how the stock price might move. And I still think that the market on a whole generally is going to be a little bit turbulent. So if you're positioning, you'd have to just position yourself accordingly. Any questions? I see we're running up on the time, but I'll take some questions. You don't have to.
Yeah, man. Any questions for Greg, guys? I mean, I have not much to add there because I do agree with you. I think that I said it on another show that I think this is a good opportunity for a lot of persons to add to your long-term portfolios in general, just the way that the market has been going. I don't see any major catalyst. Well, it would have to be something just ridiculously positive because we think God does have quite a bit of cash. For example, for them to move the needle. Fesco, I think that um, I think all the companies will look at specifically those three would need to do something kind of drastic to see any significant movement. I think that same band that they've been trading in for a while will remain. I think it's just for them to continue to consistently perform, and then when the market is different, a lot of the returns in terms of stock movement will return. And
Well, yeah, you hit
I
the
think
nail
that's
on the head. There's always there's a if you look at any expansionary cycle in the market, there's always a catalyst, right?
yeah,
And right now, the things that are happening in terms of interest rates, people paying more upon them loans, inflation high, cost of living adjusting. You can't ignore those things, right?
yeah,
Certainly some persons will be able to weather that more than others, but the market functions best when there's wide participation. When you find that participation tends to win is when things kind of go soft. And if you look at the statistics, it's kind of pointing in a soft kind of direction. But I mean, if you're a trader, if you're whatever you want to call yourself, there's always an opportunity. It's just you just have to make informed decisions.
and certainly the margins that you should expect if you're focusing short term. I don't think will be to the same effect or magnitude that it would have been in the past 2 years, but I think there are
Mhm.
still opportunities.
Yeah, man,
It's
there's
just when we
always
have
opportunity.
exactly, exactly. Yep, I agree there. So, Greg, you mentioned something I wanted persons to kind of hear a little bit more about it. You mentioned trading activity on a whole has been down. What have you
Mhm.
been seeing from that perspective?
Yeah, well, I mean, if you look even at the year over year, I think for the end of December, trade value was down, which is not surprising because with higher interest rates, that's going to impact the institutional component of the market. But I believe the last time I checked, the transactions were down as well, which means there was generally less trading. So
Is there
that
any specifics that we could get into in terms of numbers? Like it was 10,000, now it's 8,000 kind of thing.
Yeah, sure. So, well, let me just bring it up because I have it here. All right. So let's look at it as at February. Um,
Are you gonna share
this is the first
something?
time looking at it, but all right. So if you look at February, right, in the main market, there would have been in a number of transactions would have been 14,794 versus January, which was 16,000 283 trades. That was on the main market, so lower trading. But interestingly, the junior market, which everybody knows that junior market carried a swing, February's transactions were 12,673 versus January, which was
Wow.
16,017. So if you looked at it compared to February last year, the transactions in the junior market were 20,574.
Wow.
So you see, you're looking at almost at 8,000 less transactions in the market. It was even worse on the main. The main February last year, there would have been 24,369 trades. This year is 14,794. So that's almost 10,000 less trades, right? So when you see things like that, I mean, it does kind of tell you a bit of a story in terms of what's happening. That there things are slowing down, and that's fine. I mean, look, markets go through cycles, right? We had a massive bull run from 2015 till who knows when, and now we're in a bit of a contractionary cycle. But as you know, as I said, is how you look at things. Glass is half empty or half full. I mean, some of these companies that we've spoken about, they'll be around next couple of years. They'll probably be moving from strength to strength. So how do you see that in your portfolio? What's your time horizon? What's the return you're looking for? You have to be asking yourself all those questions when you're looking at the market. No, but it's certainly not. It's not going to go to zero. So it's not going to zero at all. I can tell you that. I've been through quite a bit of cycles. It's not going to go to zero. So, well, I mean, unless you own certain stocks, but that's another conversation for another day. I mean, there are stocks that have gone to zero actually, but that's another thing. So, yeah.
Okay. Yeah. So we can probably close out, Greg, by just asking you what do you think maybe the next 12 months hold? So you kind of mentioned it a little bit that you expect rates to pretty much be trending the same way until maybe like
Well, all
Q4
right.
of this
So
year.
if you're looking at the topic of rates, central bank has paused its cycle of increasing rates. However, they've tightened the market by increasing the reserve ratio requirement for banks, which simply means banks have to keep more money on reserve at BOJ as opposed to lending it out into the market. So it's going to have credit implications, right? So what that means is that, listen, there's still going to be generally a tight environment. There's money in the system now because of GOJ maturities, which I was asked the other day in another setting, if I think some of that money will flow into this market, and I'm not immediately convinced that's going to happen. That money is probably going to find its way back into fixed income. So, with an absence of inflows into the market, rates being, I would say, high for at least most of 2023, there's going to be probably persistent softness with the absence of, and as we just showed, the numbers are saying there's less trading. So that doesn't spell positive at the moment, right? But I mean, things can change. I just don't see changing immediately. Um, if the Fed, and I'm talking about the Fed because the Fed is going to influence what other global central banks doing, including our own. They just raised by 25 basis points, and their banking system is under incredible stress because of their increases in rates. If they take a more cautious stance, then that's more positive for interest rates, which means you may not see much more. If the situation in their banking system is contained, and they continue to move towards aggressively targeting inflation. And that means more rate increase, which means the BOJ will likely have to respond to that. So, as it is right now, I see things more being stable on the interest rate side, but then you're already seeing the impact of that on the equities market. So, that is reasonable to say. I'd say it will likely continue. Some companies have done very, very well. Stock prices don't really reflect those performances in terms of exuberance, but um, let's see what happens 6 months down the line. I mean, September we'll start to see if the tone changes, because I mean there's talks of a recession in the US now, and if that happens, then tourism and other things going get knocked. So there are a lot of things. There are a lot of things that's happening right now, and I mean, if you listen to the analysts, international, they change their views. The IMF revise, and then they do this up and it's down. So you really just have to kind of wait and see. But I do think that we're gonna have some more months of this relatively higher interest rate environment. Not sure we'll necessarily see rates being pushed even higher, but we're gonna see higher borrowing costs. We're gonna see some of these companies that need to finance themselves either having to take higher interest rate debt. You're going to see APOs. You're going to see some rights issues. because people still need money. Business still needs to continue, and capital is still gonna be needed. Maybe at a slower pace, but you're still gonna have those transactions that are gonna come to market. And it'll be interesting to see how the market responds to them. So, I don't know if that's telling you the future. I don't know the future per se. I just know that whatever you do, you have to tread carefully, and that's just the theme that I'm kind of working with.
Yeah, man. Yeah, man. I agree with you. I'm curious to see how the market will respond to the very next IPO on the heels of the whole SSL and just general market state of things. So I think our next discussion at the end of Q2 will be an interesting one. So we'll
Yeah.
see what the market is up to at that time and kind of see how things might have changed from this quarter to the next one. So thank you so much, Greg. I think we got some great value from the conversation with you.
I hope so.
Yeah,
Whenever
man.
people can sleep.
Yeah, man. Yeah, man. So we'll continue the conversation in the Telegram group as usual. Again, I just want to highlight JMMB Moneyline as sponsor for this episode. That's a platform that you saw us use to go through the price history. Great tool. I think some upgrades are coming soon. Would have made that announcement earlier this year already.
It's not coming soon enough, but it's coming.
It's
Right.
coming. It's coming.
There are
Yes.
other things that we can't give everything one time. I mean, I think the app is also on its way. All of these nice things. Wish I could give it to you all at once, but we can't always get what we want. So we're just trying to
Man.
give you
Yeah,
what we
man.
can.
Understood. So
Yeah.
I mean, I still think there are lots of benefits to the Moneyline platform as it is. So that's why I think persons just need to use what they have available to them, and until better comes, we work with what we have. So thanks again, Greg. And I'm not seeing any questions. Marlene is saying she's not seeing higher interest rate on savings.
Well,
That's the very last
there was
thing
a
you see.
recent survey which JMMB was one of the better paying banks in terms of savings and deposits. So, what I would say is do your market research and act accordingly. But that's a good question. And the truth is, though, if you have your money in savings, and why my banking colleagues might not like me for this, but you can, if you have your money on a 90-day deposit, you can buy a 90-day treasury bill, or you can buy a 30-day BOJ CD. You can bid on these instruments. The last BOJ CD was at 8.8%. So I'm imploring you to take action where you can, right? If you're open to that, there are options for your money that are short term that you can use to
Yeah, I mean,
maximize.
I'd much rather leave my money in a dividend stock than a savings account. Because worst case, I'm getting what
Well, look, savings
three to
accounts
seven
serve their
percent.
purpose, certainly for accumulation and all of that, but it's a part of your portfolio, right? You save to a point, then you kind of look at the other options to maximize your returns. Because I mean, a savings account isn't gonna get you across the threshold unless you're just saving some ridiculous amount of money and you don't need to invest. But not everybody is in that kind of situation. Persons need to make their money work for them, and certainly a savings account is kind of low on the priority for that, but it's a great tool for you to kind of build a base.
Amen. Agreed. All right. Thanks again, Greg. Great discussion
All right,
as
take care,
usual. So
everyone. Have a good
we'll see you
night.
next time.
All right, bye.
All right, cool. All right, guys. Thanks again for being here. Be sure to like the video. Check out the links in the description for videos that may be related to this one. We have our free stock guide that's in our link tree if you want to check that out. It gives you a nice overview of how to get started with investing. We do have our classes coming up and some other notices to be sure to subscribe to our mailing list. And again, I just want to thank everyone for being here. I'll see you in the very next video.
Learning is the key to successful investing. And who doesn't want to invest in some way?
Here at L.E.A.R.N Invest, we focus on financial education, all with the aim of sharing our knowledge on personal finance, investing, and building wealth. We do this on the foundation of our faith in God.
If a more holistic approach is what you need, check out our Grow Faith-Based Financial Coaching Program.
Find out more about us at learngrowinvestclub.com
And follow us on all social media platforms at Learn, Grow, Invest.